So welcome everyone to the latest quarterly review update from Beaufort Investment. I'm here with Shane Balkham, Head of Portfolio Construction. We're going to pose some questions to Shane. So Shane, let me start by asking what happened in the last quarter.
Thank you, Brian. Last quarter, certainly better than the first 3 months of the year, although arguably the macro environment was arguably worse, but the portfolio performance was better. What did happen? As we expected, it was all about central banks. So we had the Federal Reserve in the US still on their rate rising exercise with a rate rise in June. We fully expect rate rises in September and December as they plot their 4 rate rises for this year. Conversely, in the UK, we had Mark Carney becoming the unreliable boyfriend again, promising a rate rise in May, but because of lower than expected inflation, not fulfilling on that rate rise. But conversely, we expect that to come through in August.
And what, if any, changes have you made to the portfolios?
Only slight changes. We had our reallocation of asset classes last quarter. Most importantly, Asia being split out to having a separate allocation to Japan, and Asia now becoming Asia ex-Japan. We felt we probably had one too many funds within that sector, so we brought out just one fund from that. Apart from that, no other changes, although we are looking heavily into Japan. It's one of our favoured asset classes, so we expect to see a new Japan coming in before the end of the year.
So looking ahead, are you happy with how the portfolios are positioned?
Yes, very much so. We've done a lot of hard work on condensing the number of funds. We're in a period now where we think we're coming up to the end of this current bull market, although we don't know when it's going to finish. And you want to make sure you've got a tight set of funds within your portfolio, and we've made sure they're more defensive than they were 3 years ago.
So how do you think it looks for the next quarter?
There's going to be a lot of rhetoric, especially from the US. You've got their midterm elections coming up in November, so I expect a lot of tweets from Donald, mainly about China and tariffs, these 200 billion worth of tariffs that he's going to impose, as well as sanctions on Iran and the oil price. Closer to home in the UK, it's going to be mainly about Brexit. Whether we raise interest rates in August, what are the deals going to be? So it's going to be a lot of noise, I think mainly predicated for the US as they got their midterms coming up. But for companies, they're still on a strong, firm footing. Yes, we are considerably further down the line in our recovery, but that shouldn't mean good returns can't be achieved over the next 12 to 18 months.
So should clients or investors have any concerns with Brexit?
Like anything, the unknown does bring uncertainty, and with uncertainty comes trepidation. No one knows yet what Brexit will unveil. However, I firmly believe, as we saw in phase 1, a deal will be made, and it'll be a deal that the UK will point towards and say we've won in these areas and compromised in these areas, and so will the EU. So I fully expect on the 29th of March next year, it will be a deal that looks reasonable for everyone, and that's what it's about: compromises and victories. I think we can look towards the US, with Trump and his tariffs. I've probably taken a little bit of the heat away from us, and I think it's for the EU to put down a firm footing and a good deal for us, because then that takes the pressure off one area of their trade, and then they can concentrate on what's going over the other side of the Atlantic.
Have you got a message for our more cautious investments going forward? What should they think about this year?
Yeah, I think if you're sitting in cash at the moment and you're looking at the marketplace, we are in our 10th year of the recovery. It's naturally going to assume that, is this the right time to invest? We believe it's about time in the markets, not trying to time the markets. And although it might feel uncomfortable, we have seen over the last rolling 12-month periods, up to date, still gives you good returns. So it might feel like you're investing near the top of the market, but if you invest for a reasonable period of time, 5 to 10 years, history shows us it doesn't really matter when you invest, it's about how long you stay invested. And it's making sure you set up a goal and a level of risk that is pertinent to you as an individual client, and you stick to it. And that's up to us to make sure that you're getting the right information in a timely manner, and as a financial advisor, you're making sure your clients stick to the goals they originally set out.
Thank you, Shane. Thanks very much for your time, and I look forward to the next update.
Thank you.